Hello and welcome to our conversation on financial reporting. The focus of this session will continue on business decisions and financial statements, but we will try to understand and get more clarity on these assets and expenses while converting the decisions into financial statements. So when we say assets, you know that assets is anything which has the ability to generate future cash flows. So whenever a company acquires asset, so the acquisition of asset may result in one of the followings, may result in at the point of acquisition, okay. We're not discussing about the derived effects of um, acquisition of asset. But at the point of acquisition of asset, the impact will be either reduction in cash, you purchase assets for cash, or increase in liabilities, you buy assets, pay later, raise bonds, pay money, or it may result in increase in equity. So you acquire asset, a company acquires assets, and compensation or consideration is paid by issuing shares. Sometimes companies may buy assets in exchange of, in consideration of other assets. So by default, the acquisition of asset will result either one of these possibilities or all of them, a combination of. As we move along, we'll also see the real life examples, how companies acquire assets. Why companies acquire assets? To use them. So when the companies acquire assets and use them, depending on the nature of the assets, so they may become stock of goods. This is for revenue goods, or they may be getting into the corresponding to the property, plant, equipment, or the assets may be intangible assets. So all these assets, when are used, they're all assets. But the use of assets may not be same. Because the use of assets are same, the very purpose of acquisition of these assets are different. The recording, measurement, and impact will also be different. For the time being, in this session, we are going to focus on three types of assets and the respective uses. One is the stock of goods, they're revenue goods. They can also be, that's a main activity, main income generating activity is buying and selling of revenue goods. For example, for a computer dealer, computers is a revenue goods. For a furniture dealer, furniture is a revenue good. For a bookseller, books are the revenue goods. So property, plant, equipment are also assets because they help in generating income indirectly. Intangible assets, for example, know-how, patent, copyright, softwares. So these are intangible assets. So in today's session, we will understand when these assets are used, when these assets are acquired, they may result in this for reduction of cash, increase in equity, increase in liabilities, and change in or decrease in other assets. So when the stock of goods are used, in a sense, they're sold or they're used for manufacturing goods and then sold, then the concept of cost of goods sold comes into picture. So stock of goods is an asset because you have purchased that, the company has purchased the assets to generate future cash flows. So when they're sold or used, then they become cost. An asset becomes an expense. When a property, plant, and equipments are acquired by the company, they are assets because they'll be used for a particular period, over a period of time. So at that point of time, they are unexpired benefits. But every year you start using them, so the value of the asset goes down, and there's an accounting vocabulary called depreciation. So depreciation is a reduction in the value of the plant due to use of the assets. Cost of goods sold is a reduction in the stock of goods due to sale or use. Intangible assets are said to be amortized. Amortization, like depreciation, is a reduction in the value of the intangible. So this is unexpired benefit. Assets are unexpired benefits. Property is an unexpired benefit. Intangible asset is an unexpired benefit. But part of these assets which are used during the period, during that accounting period, they become expense. So this cycle of asset, expense, and asset is what you see in most of the businesses. So stock of goods purchased minus cost of goods sold is a closing stock. Once again, that will be an asset because that will be used for in future. Property, plant, and equipment purchase used in the form of depreciation. Then the balance is a net property, plant, equipment, which is an asset. Depreciation is an expense. If I ask a question, why should I charge depreciation? Why should a company show amortization as an expense? This is because of matching concept. The matching concept says income for the period should be determined by comparing the corresponding revenue, the revenue with the corresponding expense for the period or the capacity. So these expenses are charged to the revenue to derive the profit. And the balance, the remaining asset, will remain on the balance sheet as asset. So observe this flow. Asset purchase, asset use, then asset remains and continues. Okay, this process goes on. So all are assets, but why should a company classify them? The classification of assets is mostly because of the measurement principles are not same. The way company will measure and report cost of goods sold or stock of goods is different completely from the property, plant, and equipment or intangibles. So what will be the measurement principles? They're all guided by the respective accounting standards. And the focus of this session is not about the accounting standards. We are only trying to understand the uh, corresponding accounting standard. So for the accounting standard, which will talk about the measurement of stock of goods or the revenue goods or inventory, different names, and the corresponding cost of goods sold, and the corresponding unsold stock is given under Ind AS 2. So Ind AS 2 will tell us about the measurement and presentation. In the same way, the measurement of property, plant, equipment, the corresponding depreciation, and the net value of that plant, which is cost minus depreciation, is as per Ind AS 16. Similarly, for intangible assets, the cost of measurement at the time of acquisition, the cost of using, that is amortization, and the net value is again governed by Ind AS 38. So Though all these are assets and some more assets like investment and others will come into picture, but all these assets are measured through the respective accounting standards. That's not the focus of this session, okay? For each of these item, asset and respective expense, and with the respective accounting standard will become our conversation, focus of our conversation as we move along. Similarly, expenses are expired benefit. Expenses are the costs incurred to generate income. Costs incurred to generate income. So all these, COGS, depreciation, amortization, are very obvious expenses. There are other expenses like salary, rent, electricity, so on and so forth. But observe their behavior. Sometimes the companies, when the expenses are due, remember that expenses are always for a particular period, and the period is an accounting period concept. Expenses should be recorded independent of the fact whether paid or not paid. Accrual concept. The corresponding expenses should be deducted from the income to derive profit is a matching concept. So these three are very important concepts while explaining and understanding expenses. So expenses, recording expense is a matter of principle. But payment of expense is a matter of management decision. So therefore, sometimes companies pay expenses on time, due and paid, cash outflow and also an expense. Sometimes the expenses are due but not paid, but accrual and matching will say still you have to record it. So it's an expense but a liability. Expense but a liability. But sometimes the company, out of compulsion or for some business reasons, they pay advance. So that is expense paid but not due. So the impact of expenses and the corresponding payment depends on this. Either it is a liability or an asset or just expense and outflow of cash. Not only outflow of cash, sometimes you can pay expenses through shares. You can pay, a company can pay by issuing bonds. So it may result in reduction of cash or creation of liability or creation of equity or some reduction in other assets. So with this background, we know that the financing decisions, investment decisions, operating decisions of a company will involve financial items, and these financial items will find place in the financial statements. And this process is governed by generally accepted accounting principles. Now let us go to this Excel. So this is a transaction for the year. So accounting period is 1 year. Always be clear about accounting period. With accrual and matching depends on the accounting period. Find for what period you are deriving profit. For a quarter, for a month, for a year. Always be aware of that at least. And this is an existing business. That's why they have the assets and liabilities and equity. So with this balance sheet, the company undertakes transactions or take decision. We will see the impact of that on the financial statements. The company purchase stock of, not purchase, the company is already having stock here. Company sold the stock. This is the business is buying and selling toys. If the company sold this stock for 350,000, that is a sales. The company is having has earned and received cash. So it is an income and a receipt. Or the company has received money because of the sale, and sale is an income for that organization. But due to matching concept, we are bound to show the cost of goods sold. The cost of goods sold in this case is 20% of the stock sold, 20% of the stock sold. 20% of what? 20% of the inventory which was there with the company. 20% of the inventory which the company had in the beginning, 20% of this. So the stock, which is an asset, has become an expense because to that extent, the benefit has expired. If the benefit is expired, to that extent, the asset will go down. So observe the assets. The asset, in this case, stock of goods, has come down from the from 950,000 to 760,000. Reduction in the stock due to COGS. Good. The company purchased a molding plant. They purchased a molding plant, and the life of the plant, it's an asset, and it will be used. Life means it will be used for next 8 years. And it was purchased on 1st April at the beginning of the accounting year. It's an acquisition of asset. The company purchased assets. What is the cost of that asset? Is 200,000. Did the company pay money for that? The answer is yes, there is an outflow of cash. There's an outflow of cash. So acquisition of asset resulted in outflow of cash. And this asset, because it's going to generate future cash flow or help in generating future cash flow. But what is a life? Life is 8. And this is we have used for 1 year. So there is a corresponding reduction in the value of the asset, and that is a depreciation on plant. For the time being, we are using a very simple formula to derive depreciation. Depreciation is equal to cost divided by life. Cost divided by life is depreciation. But depreciation is a reduction in the value of the plant due to use. No outflow of cash. So there is no impact on the cash flow. But the value of the plant will reduce. It's a reduction in the value of the plant. Therefore, we will show the reduction in the value of the plant as a negative asset. Okay, reduction. So it's a good presentation principle to show, instead of reducing the plant directly, show as a separate line item, that is the asset accumulated depreciation. So acquisition of asset resulted in decrease in cash. Use of asset led to depreciation, and depreciation is an expense, and depreciation is a reduction in the value of the asset. Depreciation is not a cash flow. Every expense is not an outflow of cash. Every payment is not an expense. Okay, that's an important relationship. Similarly, the company purchased a CRM software, and it's an intangible asset. It may be having reading material or user manual, but the software sits on the computing system or your servers. You can't see that, but it will work. So it is an intangible asset. Acquisition of CRM is an asset acquisition. But did the company pay money for that? Cash? No, they did not pay cash. But how did they acquire? The company acquired by issuing shares. And when they acquire asset by issuing shares, we can see that the value of the capital increases. Observe that. Why did the value of the capital increase? Because the company acquired a software, which is an intangible asset. In consideration of the acquisition of this asset, they paid them, the supplier, by issuing shares to them. And this is a very common acquisition method, particularly for startups. Okay, so depreciation is an expense, is a reduction in the value of the asset. Depreciation has to be shown or recorded because of matching principle to derive profit. In the same way, CRM, if you observe, plant has been purchased and there is a corresponding depreciation. CRM is also having a life. Observe that the CRM life is 10. So there is an amortization of CRM. Amortization of CRM. Once again, no cash outflow, but there is a reduction in the value of CRM, and we call it less accumulated amortization. Okay, amortization. So depreciation is an expense, amortization is expense, COGS is an expense. That's what we saw here. Depreciation is an expense, COGS is an expense, amortization is expense. But because of these three, the value of the asset reduces, value of the plant reduces, the value of intangible reduces. And that is precisely what we saw here. The plant has come down because of depreciation. Intangible asset has come down because of amortization. Inventory has come down because of the COGS, because of COGS reduction, corresponding reduction. Collection of debtors. A debtor is a receivable from customers. So the company received money. Why did the company receive money? From whom? It is the money received from the customers. Okay, it's not a money received because of sales. It is sales happened in the last year. And that was recorded because of accrual and matching. All that we are doing is receiving money this time. So this collection is not income for the period. This was the income of the previous period. That is why accounting period, matching concept, and accrual concepts are three important concepts which affect the financial statements. So the collection of debtors, because of that, the value of the debtors will reduce. What is collection? Collection is a receipt, not an income, not a capital, not a liability, but reduction in an asset called trade receivable. So every receipt is not an income. This again proves every receipt is not an income. Some receipts are capital, some are debts, some are incomes, some are reduction in the assets. Now, salary for the month, these are operating decisions. You should be clear. Now, all these are operating. Okay? Regular, recurring, I'll use recurring decisions. So, salaries for the month, 20,000. And our accounting period is year. So, therefore, our expense is 20,000 into 12. But the company paid only for 11 months. You may ask, how come 11 months? We can see that here. The salaries are paid in the first week of the next month. So the salaries of March will be paid in April. But what about the salaries of March 23? Have been paid because there is no liability on the balance sheet. This is why I often say read the balance sheet, listen to the numbers on the balance sheet, talk to them. So there is an important business decision the company has done, that from this year onwards, they changed the methods of payment of salary. They said that we are going to pay dates, that we are going to pay in the beginning of the next month. Till last year, they paid the month's salary in the month. So therefore, there was no salary payable the balance sheet. Okay. So expense not paid is a liability. Whereas, let us see the rent. Rent is a per month is 10,000. Okay, per month is 10,000. So we pay rent. Rent is an expense. Rent is an expense. But did the company pay rent? Yes, they paid rent. And the amount of payment of rent is 150,000. Rent per year is 120,000. But payment is, so expense paid. If the payment is more than the expense, there is an asset, corresponding asset. And the corresponding asset is advance rent. Corresponding asset is the advance rent. Expense not paid is a liability. Expense paid but not due, then it is an asset because you're going to get the benefits in future. That brings us to a very common item, is an interest. For the year, I have to pay interest. So interest is equal to 12, what percent is? Yeah, 12% on the loan. And remember, this is interest, not EMI. So there is no reduction in the principal. It's only a payment of interest. And the interest is also paid on time. That's what the management says. Interest has been paid at the end of the year. So once all the transactions transferred done, all transactions have been recorded, measured and recorded. So the three steps: find profit, find cash, balance the equation. So let us find profit. So profit for the period before tax, okay, is a income minus expenses other than tax, and that is, okay, so that is equal to the profit before tax is equal to 289,000 loss, negative. Because it's a negative, without getting into the nitty-gritty of taxation, there'll be no tax. Tax is on profit. So 289,000. Who will bear this loss? By default, profit belongs to the shareholder. Loss will be borne by the shareholder. Therefore, our reserves will go down to that extent. Reserves will go down to that extent. Why did the reserve go down? Reserves are accumulated profits. Now this year the company incurred a loss of 289. Therefore, the reserves will go down. So equity will go down. So no tax. So the entire PAT is adjusted to the reserves. That brings us to the end of income statement. Let us find cash in hand. Cash in hand is equal to cash available minus the cash payment is a cash in hand. 1.1 million minus 1.1 million minus 594,000 will give me 536. So 536,000 is cash in hand. Is cash in hand. And cash in hand is an asset. So transfer that to the balance sheet because that is an asset as on that date. Which date? As on 31st March 24. So these two items, keep a watch always. Keep a watch. Profit reserves, accumulated profits or retained profits, and the cash. They show the clear relationship between connection between financial statements, income statement, cash flow statement, and the balance sheet. Now let us close the equation or let us close the balance sheet. So during the period, the company did not take any new loan. The company did not take any new loan. So the loan remains at 200,000. The company did not pay the creditors. So creditors stay at 390,000. No change in creditors. If no change in creditors, no change in loan, then the total assets of the company is 2.281. Okay. So let us highlight it. No change in the shares as investments. Huh? No change in the shares as investment. And no change in, there's no other item because all other items have been taken care. So the balance sheet of the company, if we are not wrong, will tally 2.28 million. So observe the assets and the corresponding expenses. That is the focus of this particular presentation. But if you observe these financial statements, we have not yet started using the accounting standards and the Companies Act forms for this presentation. We're just trying to understand the model. All items will appear in the income statement, balance sheet, and cash flow statement. As we saw the classification of assets, some of these assets are current assets and some are non-current assets. Okay, some of these liabilities are current liabilities, some are non-current liabilities. Here, we did not classify them, we did not present them in that manner. So if you go down here, you see the same question, I just presented in a different manner. Okay, we just presented. The presentation is to show that the classification of assets and liabilities, equity by default is long term. The liabilities may be non-current liabilities and current liabilities. The assets may be non-current assets and current assets. That's a company's decision to classify. You cannot say that shares are always non-current. Here we are treated as non-current. But shares may be non-current or current depending on the intention of the investment. Intention of the investment. So, and in order to understand the intention, we have to see the management decisions. At present, we are not privy to that. We don't know. We are treating them as the what you call long-term shares. Okay, so let me just show that plant, non-plant 350. Okay, stock accumulated depreciation. No. So plant, so there is, okay, so yeah. Now, this cash flows an income statement and the balance sheet, therefore the fundamental financial statements of the company. whatever is the complexity of these transactions, that will be or can be converted into financial statements. And the focus of this session was to understand the assets and expenses. That is what we spend some more time on these items. That is COGS, cost of goods sold, depreciation, and amortization. We'll take a minute to understand the cash flow a bit more. The cash flow statement is, of course, cash in hand is opening plus receipts minus payments. But the Ind AS 7, which governs the cash flow reporting, says you need to classify these cash flows into operating cash flows, financing cash flows, and investment cash flow. So sales, let us classify that. Sales is a operating decisions, is a result of, because it deals with the customers, operating activity. Collection is the money collected from trade receivables, so therefore it is also an operating decision. What else are the operating? Salary is operating. Rent is operating. Rent is operating. In this case, there are no other expenses. Plant purchase is an investment decision because that results in acquisition of asset. CRM is the acquisition of asset, though it is zero here, because we did not pay money, but that's an investment decision. And interest is a financing decision, is a financing cash flow. Financing cash flows. So accounting standard, which we will see in detail later, says the cash flows should be classified into OD, ID, FD. So the same cash flow statement, therefore, we can also present like this. Okay? Opening cash in hand, CFO, cash from operations, is 350 plus 280 minus 200,000 minus this zero. Okay? Cash from investment decisions, CFI. There is no inflow, there is only outflow. Okay, there is only outflow. So negative 200, cash outflow. And CFF, once again, the company did not raise any cash, any loan or any capital, no inflow, but there is an outflow. And so cash in hand, the cash in hand at any point of time will be, we can just see that is the summation of what is this operating decisions? The operating decision is, oh, we made a mistake here, is sales plus collection minus salary minus rent. Okay? Minus salary and minus rent. That is cash from operation. Cash from investment is the purchase of plant. Therefore, negative. Cash from financing is a payment of interest. No other, no raising of money, no payment of dividend. So only financing activity that happened here is the interest payment. And this is closing cash in hand. So the accounting standard very clearly says that we should classify the cash flows. But that type of classification is not there in income statement and the balance sheet as of now. Okay, so this brings us to the end of this session where we try to understand the uh, assets, expenses, and the financial statements. Our objective is to consolidate this understanding. Keeping that in mind, we saw expenses, assets, and the relevant other incomes and expenses. So before I close, I'd say that for us, our objective is to understand decisions, not recording of transaction. So observe decisions, understand decisions, identify items, measure the item, and show them in the financial statements. Thank you very much.